Hi, welcome to our webinar, Retire Using Real Estate Investing. My name is Lori Carter. I'm the program coordinator here at UTA Continuing Education, and we're going to give it just a few minutes. People are still piling in. Thank you for spending your lunch hour with us today, and we'll get started in just a minute or two, and I'll introduce Josh and turn it over to him.
All right, folks. Well, good afternoon and welcome again to Retire Using Real Estate Investing. My name is Josh Strittmatter. Hope everyone's having a great day. A little bit of information about me before we get started. I am a financial planner and I have been since 2003. And I'm a real estate investor and from about the same time frame as well. I've always enjoyed investing in real estate. And so, and then I'm a continuing education instructor at UTA, and I've been doing that since 2010. So today's topic is very interesting to me, and I'm really excited to present it to you today. A little bit of disclosures before we get going. So today we're going to be talking about tax and legal information, and it's purely educational, folks. So be sure and talk to your licensed professional before taking any action on that. And then also we'll be looking at some projections. And in those projections, there will be calculations that are forward-looking, and they will be hypothetical. So keep that in mind, is that there is no guarantee of the rate of return or how we're or the calculations that we've done today. They are purely hypothetical. So be sure and talk to a licensed professional about that as well before you get going. Here's our agenda for the day. So we're going to talk about why you should diversify into single family rentals, how the rate of return is calculated on real estate investing. We're going to talk about the tax benefits and go over the ins and outs of all the tax benefits that you get in investing in real estate. We'll talk about why isn't everybody investing in real estate, and then I'll show you how you can begin investing in real estate. By the way, if you have any questions as we go along today, feel free to just type them in. We have a chat feature, and I'll be monitoring that. And then I'll take some questions at the end as well. So just be sure and just type your question in. So starting off with, why diversify into real estate? SFRs, single family rentals, have low correlation to the stock market historically. So they don't move in tandem. So when we're saying diversifying outside of the stock market means looking for places that you can invest into that don't move exactly with the stock market, because that really doesn't benefit you when you're trying to reduce your overall risk. And so single family rentals has been a great place to diversify into to help reduce your overall risk. Also, when we talk about single family rentals are typically homes, or duplexes or triplexes or quadplexes. So not commercial is the way to think about that. Also, single family rentals have lower price volatility than the stock market historically. So less of a roller coaster ride. Many of you have seen the stock market in the last couple of years and you've experienced that roller coaster ride. And residential real estate just doesn't move like that. And then also there's the potential for better rate of return due to leverage and tax benefits. And we're going to get into that today and talk about how that works. So let's look at a quick chart here. This shows you a comparison between single family rentals, stocks, and bonds over about a 25-year period. And so it shows you really how volatile stocks can be. Stocks show the red line there. And you can see there's lots of zigs and zags there. Bonds also can be quite volatile. And those are 10-year treasury bonds, by the way. So that's the debt of the US government. And you can see that those can be quite volatile too as well. But when you look at real estate really doesn't have a lot of volatility in it. You can see the 2008 crash here that occurred, but then you saw the recovery that occurred after that. Now we've experienced, and that's not on here obviously, but we've seen in the last few months with real estate has really just taken off. But that being said, is overall, real estate really can be much lower volatile than the other two categories. It looks like I have a question here. Yeah, so question is what is the risk of renters not paying rent due to government policies and the impact that the new market landlords might have as they plan to offset this risk? That's a great question. And so right now, we do have the government program that allows renters to apply for and get renters assistance. And so in doing so, what that allows them to do is to have the programs, and it's set up by state, to basically have the state provide funds for their rent. And that's basically paid right to the landlord. And so you had a moratorium on paying rent for a while, and that's gone away now. So now but you still have the rent repayment plan. And I don't know the exact term of it. I'm actually part of that plan because I have a renter that is paying me through that plan right now, and it's worked just fine. So I would say right now, in today's current environment, that risk is pretty much gone away because most of those government programs have stopped, the moratoriums have stopped, but the programs to help pay the rent have stayed in place, which has been beneficial to the renters and to the landlords. So I'd say that's actually a not a bad place right now. And the other thing I'd say about that too is back when that was occurring, it was a very low percentage of renters that weren't paying their rent. So you saw just not a huge quantity of people that was affecting. So that's another thing, is that I think on the whole, if people could pay their rent, they do pay their rent. Okay, looking at a second reason why you should diversify is the millennials. Millennials is the largest part of our population right now. They represent a fourth of our population in the United States. And they prefer to rent over buying historically. And the reason is that historically they've been underemployed. So it's pretty interesting reading about them that they have some unique traits. They prefer to be mobile. They like to travel. They don't want to be tied down. And they really value quality of life. And you're starting to see that in many other areas, whether it's working from home these days, but a generation that doesn't prefer to own. Now that may change as they get older, but as of right now, it has created a steady demand for rents. Let's talk about the average annual rate of return of the stock market. So this is looking at the S&P 500 index, which is just a benchmark or index that's used to look at the 500 largest stocks in the United States. And so this is looking at from 2000 to 2019. What that average rate of return has been is 7.68%. So that's the annual average rate of return. What about real estate? So real estate is looked at by the Case-Shiller Real Estate Index. And this is looking at the last 20 years through the end of 2020. That's a little typo there, but it's 2020. And it shows you that the average growth rate per year has been 6%. And that even includes going through that 2008 crash. So less than the stock market. However, just price appreciation, which is what that represents. So that's the value of the home going up. By the way, this is a 20-city composite index, is 6%. So just the price going up. So there's more to the rate of return now. In fact, there are 5 main components to the rate of return for real estate. We're going to go through each of these. So we just talked about price appreciation. Let's next talk about income. So income is looking at rent from real estate. And so I use this presentation for other purposes, but Jim is interested in investing in real estate. He wants to know, is it a good investment? What does he need to know to invest in real estate? What type of properties are the best to invest into? How much time will it take, and how can he get started? We're going to talk about all of those things today. Let's first of all look at some assumptions here. So this is going to be a calculation, or a property, I should say, example that we look at throughout this entire presentation. I'm going to go slow here because I know that not everybody's good at math, but I'm going to try to make it as simple as possible here as I explain these ideas to you. So starting off with the investment property value, we're going to assume that this property is worth $200,000. And that the average price appreciation in the area is 5%. So I mentioned earlier that that national index was 6%. We're just going to assume 5%. And so that's annually increasing by 5%. We're going to assume a house size of 2,000 square feet. And that's important because rent is often quoted based off of the square footage of a house. So in this case, we're going to make it simple. $1 per square foot is the price of rent. And then the average inflation rate is 3%. This is for income and expenses. So the rent's increasing at 3% and the expenses are increasing at 3%. We're going to assume that rent is covered by half of the operating expenses and that the tax rate is 22% of this investor. So Jim's going to invest $200,000 into a house that's going to grow 5% per year. After 15 years, that $200,000 will be worth $415,786. That's just due to compounding. So that's a future value calculation at 5% over 15 years. That's the ending value. But again, he's also going to receive rent. And so rent is, again, $1 per square foot times 2,000 square feet. That's 2,000 per month, which is 24,000 per year. Again, that's inflating at 3%. So the total income over 15 years that would be paid out to Jim is $446,374. So again, just a future value calculation. That rent of $24,000 every year, growing at 3% over 15 years, and then just the totaling of all of those numbers is $446,000. In this example, I'm going to assume that half of the rent goes to pay for the expenses of the property. So in this example, Jim just paid cash for the property. He paid $200,000 for this property, so he owns it outright. And then we're going to assume that rent is half, or half of rent rather, is half of the expenses of that property. So repairs, things like that. So the total rent to the owner is $223,187. So if we add the total rent to the price appreciation over that 15-year time frame, that's $638,973. We're going to subtract out our initial investment of $200,000, and that nets him $438,973. And what that equates to is 8.05% per year annual compound rate of return. So now we're getting pretty close to the stock market. In fact, we got a little bit over it. So it shows you that real estate is on par with investing in stocks. And so it's a great place to diversify, not only for the rate of return, but also because of the lower volatility that it provides to you as well. Real estate also has some other great benefits, though. You also have tax deductions. And so when you're looking at rental properties, you can deduct lots of the expenses that you have. Things like mortgage interest, property taxes, property management fees, repairs. Those are all deductible against the passive income that you receive. So passive income is the rental income. Property is also depreciated over time using what's called the Macker's General Depreciation Schedule, and that's over a 27.5-year time frame. Those are also deductible from passive income. Keep in mind that many people actually have more deductions than they have income. And so as a taxpayer, you don't lose those deductions. You can carry those deductions forward and use them in future years to help offset income in future years. So that is how taxes work. Let's look at it as an example. This shows you the annual deduction expenses. So this is looking back at that example of rent. I assume that half of the rent were the expenses of the property. So in this case, $223,000 are deductible expenses. And the depreciation schedule for this is $7,272 per year, $7,272 per year. So that equates to $109,080 per year. That doesn't change. That's just a flat amount that you receive over each year over that 15-year time frame. And then the total deductible expenses over this 15-year time frame is $331,267 at a tax rate of 22%. That equates to $72,879. That is money that Jim gets to keep in his pocket. So normally, if he was paying tax on this money, he would have paid out $72,000 out of his pocket to the IRS. But because he's investing in real estate and getting the deductions and the depreciation, he gets to keep $72,000 in his pocket. So pretty powerful. And then lastly, the last component of your rate of return is the power of leverage. And leverage is really a fantastic tool when you're investing, folks. And it's because you get to use other people's money and have somebody else pay them back. And that's really the true value of investing in real estate, is that you can use a mortgage to buy the property and then have a tenant pay that mortgage back. Let's look at an example of that. This shows you that in scenario one, we had the $200,000 that Jim paid cash for. And then after 15 years at 5%, that grew to $415,786. I'm not going to include rent in that calculation there. And it's because I'm not going to include it here. So scenario two is using leverage. In the second scenario, Jim's going to take that same $200,000 that he's investing into one property, but now he's going to put 20% down on 5 properties. So 20, and they're all worth $200,000. We're going to make that assumption. So 20% of 200,000 is 40,000. 40,000 times 5 is 200,000. So he's going to be able to buy 5 properties with his $200,000, and the remaining 80%, he's going to get a mortgage. So he's going to get loans for that 80% of the remaining value. So he now owns 5 properties worth $200,000 each, which is $1 million. And in 15 years, each property will be worth $415,786. So 5 properties worth $415,786 equals $2,078,928. So what that equates to is 16.89% annual compound rate of return. And remember, folks, is that we assume no rent, because when you have properties that you have mortgages on, you've got to obviously pay those mortgages. So in this scenario, I'm assuming no net rent is received to the investor. We're just simply looking at the price appreciation over time. So hopefully that was understandable. Here's Jim. He's super excited about his rate of return. And again, let me stress this idea is that you get outsized returns with real estate when you're using leverage. Leverage allows you that opportunity to invest in using other people's money to maximize your overall rate of return. Now, there's also risk involved with leverage, and it's something you need to be aware of as well, that obviously you can lose more if the value goes down than what you paid for it. And indeed, for people back in 2008, that was a key risk. Now, what I would tell you, though, is that back then, it was a unique situation where you had a marketplace that was just loans were sold through specialized instruments that basically were sold incorrectly. And so because of that, you had a massive fallout with real estate. I don't know that we'll ever see that again, because they changed rules around real estate in terms of what people can borrow for real estate. And in doing so, they've made it a little bit more difficult for people to borrow. So that scenario, I don't think will happen again. And so that type of risk, I think, was unique to that situation. I thought I'd get a question about that. Yeah, an emergency fund. So I talk about that in a future slide, actually. So the question is, how much money should I keep in an emergency fund? And I recommend, when you're looking at investing in real estate, it's important to have an emergency fund, because obviously you have tenants that will move out, that will not be able to pay their rent for reasons, and you're going to have to pay that mortgage. Now, this is again assuming that you get a mortgage on the house. There's lots of people that still invest into real estate and pay cash. So, but you do need to have funds available to pay rent and also for repairs and things like that. So when it's the right time to invest in real estate, if you're gonna retain that property and rent it out, is when you have enough assets that it won't put you behind, or you won't have to go borrow money to make a repair cost. It's important to have a good cash reserve. And again, I don't recommend that you put all your investments into real estate. It's also important to have investments outside of real estate as well. That way you can tap into those investments if you need to. But Jennifer, to specifically answer your question around a cash reserve, I always recommend to have, when you're dealing with real estate, about 6 to 12 months worth of expenses for yourself. And especially if you're working and you don't have a sizable nest egg, it's good to have about 6 to 12 months of your expenses that you've saved. Now with real estate, when you're talking about rent or repairs, it might be a good idea to have maybe 6 to 12 months of rent or repairs, expected repairs. And that way you can have money set aside so that you're not panicking when something goes awry. So here's some reasons why people don't invest in real estate, folks. And some of these may sound familiar to you. Lack of knowledge. Investing in real estate requires a great bit of knowledge to get it right and to make money. Lack of time. People are busy. They work full-time jobs. And so it's often difficult for them to spend the time doing it. Lack of capital. So where to get the money? We'll talk about some money sources today. Lack of skill set. All types of laws to be aware of, IRS code, fear of mistakes, don't want to mess up. And then I find the biggest reason why people don't do it is procrastination. So everybody is, in general, smart enough to do this, but they just don't get to it. And so they procrastinate, and so it doesn't happen. And remember, experience is key. So one of the things that I stress to investors is that investing in real estate takes time. You got to do the research. You got to put in the hours and do the numbers. Often you're visiting properties. It involves negotiating skills, knowledge of tax law, real estate law, how to structure debt, and then having relationships with professionals whom you trust is also important. We'll talk about some of these things today. So how can you get involved in investing in real estate? Well, here are some sources that you can start looking at for properties. So MLS is a system that's used to post properties. And in general, you have to be a licensed real estate agent to do so, but you can get your real estate license. Lots of people do that. They're in Texas, it's 6 courses that you can take. And once you take those 6 courses, there's a final exam that you take. And just so you know, to become an agent it's really not that difficult, I would tell you, is as long as you're okay with taking tests, but that gives you access to the MLS. Zillow, by the way, is another great source for properties. Zillow is a tool that you can log into and look for properties. Auctions is another place. Probate is a unique place to try to go find properties. And that's basically looking for estates where people have passed away and they may be getting rid of their properties. And then wholesalers is also a popular place to go properties for rehabbing. So rehabbing is kind of a different beast in that you've got to be able to estimate repairs accurately. And in doing so, be able to sell it for a price that you paid, a price higher than what you paid. So, but wholesalers is a great place. And generally with the wholesaler, you can subscribe to an email that they send each day, typically, with different properties that are on the market. The way a wholesaler works, by the way, is that they're the ones that buy cash for houses, right? Where you see all the signs, and then they'll negotiate with the seller for a certain price, and then they put it up for sale for a certain price, and there's a spread, so a margin, a price above what they're paying. And in doing so, they actually sell it, and many times before they even take ownership of the property. So they're the middle person, so to speak, but they're a place where they can go find properties and sell them to you for typically below market and in doing so, be able to rehab them. Very important to do your due diligence. So doing your research is important. And this is where you really need to become good at reading books, I would say. And that's how I learned. And just starting to kind of spend some time on it. So things that you would research are comparable property prices. The MLS system and Zillow is a great tool to help you to find property prices and compare property prices. You'd obviously want to look at historical rent in the areas. MLS actually posts historical rents as well, so that you can go and see what the rents have been in the area. And then beyond that, Zillow does the same. Area schools. So depending on your strategy, if you're going to do a buy and hold, and again, you're going to rent the property out, oftentimes young families will rent out houses. And so it's important to look at the schools in the area that you're buying. Same thing, crime rates. It's important to know what the crime rates are in the area. Property tax. Property taxes can really make or break a deal. So that's very important to look at and know the differences between property taxes. And I'll tell you about a key learning that I had is there are property taxes that aren't necessarily posted on the property tax website. So we looked at some Houston properties as an example, and Houston has a municipal utilities district, and it's called a MUD, and it's not posted on the tax appraisal district's website. You actually have to do the calculation on your own, and it's actually, for the property that I was looking at, was twice the value, or twice the rate, I should say, of the actual property taxes that were posted. So you as an investor, you may go in and look at that property tax, and it's a statement, and you'd see a certain value, and you say, oh, those are the property taxes. But you have to know to go that extra step to see that it's part of a MUD district is what it's called, municipal utilities district, and know that the property taxes were actually twice that cost. So if you didn't know that, that could ding you, right? So learning how property taxes work is important. Also, deed restrictions. Some properties these days, there's a property actually in a neighborhood next to me that if you haven't lived in the house for 5 years, you can't rent that house out. So if you can't buy the house to rent it out, that wouldn't be a good investment unless you're seeking to flip it. Cash flowing is very important, obviously. So cash flowing simply means that you have more money coming in than you're sending out. So the rent needs to be enough to cover any cost that you have, whether that be a mortgage, repairs, things like that. You need to factor that in, and a cash flowing property has positive cash flow, and that's generally what you look for. Rehabbing costs. So again, if you're going to be a rehabber, it's important to, and what I always tell people to do is, if you're going to do that, is don't jump into it. Start talking to other people who are doing it. Start creating a network or an alliance of people that are doing it already, and see what you can learn. Take a good year to learn before you jump into rehab, because that can be some expensive lessons to you. There are costs that you may not even be aware of that can go into that rehabbing. And so it's just important to become well educated before you jump into rehabbing. After repair value is often a term that's used, and that's basically when you're looking at rehabbing, you want to make sure that you know what the after repair value will be, because you want to compare that to market value to make sure that you have built-in margin, built-in profit, in other words. If you have a question, be sure and type it in, folks, rather than raising your hand, and I'll be able to answer those questions for you. Look for the properties with the highest potential for price appreciation. So here again, when you're thinking long-term, you're looking and you're wanting to have a rental property, you want to look in quality neighborhoods. So, it can be a challenge to find a property in a low income area and retain that property for a long period of time if you're dealing with tenants that might not be the easiest to work with. So quality neighborhoods makes it a little bit easier. Again, excellent schools is important. Growing populations. So, that's something to consider. Is DFW is one of the fastest growing metroplexes right now. So people are moving here. And so what is the future demand for rental properties for wherever you're buying will be very important. and populations is something to consider. Look for properties with highest potential for rising rental income per square foot. So high rent areas, again, you can look on the Zillow website or the MLS website if you have access to it to see what rents are in the area. And you also want to look for a history of increasing rents. So look to see where are some areas that really those values have increased over time. Generally, what you want to look for is large concentration of businesses, so jobs, in other words. Finding houses where there are large, areas or large companies in the area that provide lots of jobs to the area is something that's important. Great thing about DFW too is that we obviously have lots of corporations that this is their home office. And so that again is a major reason why we're growing in DFW is because people are moving here for the jobs. You'll want to negotiate, and in looking at your negotiating, it's important to do your due diligence on what you think the repairs cost will be, obviously. And so depending on your strategy, again, I think about kind of two different strategies: buy and hold versus rehabbing, also called flipping. And so buy and hold, typically you're going to try to buy a property for below market, but you're also going to look at the repair cost. And so when we go into buy properties, we always do an option period. And so in Texas, you can pay for an option period. Typically, it's $100 is what you pay on your contract. What that allows you to do is go in and assess the property, have an inspector review the property, and then in doing so, come back with the repairs that are needed and then go out and get quotes for those repairs. You can then use those repairs to negotiate the price lower during the option period. So it's important to do that quickly, obviously, because you won't have much time to do it depending on your option period. And 10 days is the typical option period that I use. And so 10 days means I got to get stuff done quickly. And again, I can go back and renegotiate that contract based on the repairs. And sometimes they'll negotiate with me, sometimes they won't. But if it's not a good deal with the repairs, we simply end the contract during the option period. And so what that means is we lose our option money, which is typically $100, but we get our earnest money back. So earnest money is basically the deposit that you're putting down, and that's refundable to you during the option period. So keep in mind your outlay as well. Again, is if your strategy is to use leverage, you're trying to minimize your outlay so that you can have more money to buy more properties, and then minimize unnecessary fees and expenses. And so having relationships with title offices and with lenders so that you know the fees going in and then negotiating those fees where possible is going to help your bottom line. So know what your fees are that you're going to pay, and make sure that if they can be negotiated, that you're bringing it up and negotiating those fees. Debt structure. So again, assuming you're going to use debt, it's important to know what debts are available to you or what types of loans are available to you. And so typically an investor will use a conventional loan, and conventional loans are loans that will allow you to purchase those properties at a pretty low rate. So that's the appeal of a conventional loan. And you can do 15, 30-year notes. Typically, we'll do a 30-year note. And the reason for that is that interest rates are really low right now. So utilizing low interest rates for 30 years helps you to make more money over time. Now, conventional loans have a limit of 10 properties that you can do under that umbrella, under that type of loan. But outside of that, you can begin to use package loans. Package loans is provided through a package loan lender. And so that's why they'll structure a deal where they might refinance your 10 properties that you have and do it under one loan, which then opens it up for you to do 10 new conventional loans. And so knowing how to structure debt is a strategy that will help you to reduce your overall cost of debt over time, and then help you to maximize the amount of money that you're receiving. By the way, if you're in the rehab business, which means you're flipping that deal, if you don't have cash, what often people will use is hard money lenders. Hard money lenders are short-term loans, typically at a pretty high interest rate, typically about 12% right now, where they will charge you what are called points or interest rates to get the loan. And then you'll have a period of time to pay that loan back. And then at the end of that loan, or that time frame rather, if you haven't paid the loan back, you can either get an extension, which costs you more money, or if it doesn't look like it's going to work out for you, that hard money lender has the house as collateral, so they'll foreclose on you and just take the property back from you. So when you hear about people talking about getting into real estate with no money, it's through hard money lending. Hard money lending is how they're doing it, because for hard money lenders, it's a pretty nice business for people who do that, because they are making money on the property by loaning that money to you. And then again, if you foreclose on that property, the amount of money that they lend is typically 70% of the value of the property. So they can take that property and sell that property and still make money, even if you foreclose. So that's why they do it. And that therefore that opens the door for investors to be able to get in and buy properties without any money. I always think it's important to have a team approach when you're investing. And so, especially with real estate, there are a lot of different areas that would just take too much time to become an expert in. And so by using professionals, this allows you to have a team of people who can help you to avoid making mistakes. And I think that's the key reason why you want to use professionals, people who know what they're doing, know how to avoid mistakes so that it doesn't cost you lots of money in the long term. So people like mortgage brokers, different lending companies that you can begin to build relationships with so that you can build up a portfolio of rental properties. Real estate tax specialists are important. Real estate is pretty complex, and so some CPAs are knowledgeable about it. Some really kind of have just minimal knowledge about it. They know enough to do a tax return, but there's a lot of areas that you can save money on taxes with real estate. So it's to your advantage as an investor to work with a tax advisor who specializes in real estate. Same thing with real estate attorneys. It's important to team up with some great attorneys, and especially if you're renting properties, be ready to evict. Don't wait till it's time to evict. Have your attorney service ready to go. And the great news about evictions is there are attorney services that kind of come as a flat cost. So we utilize one that charges, I think it's $650 as a flat fee to do the full eviction. You just call them and you give them the details and they get to work. And so you don't have to worry about it. Also, setting up and how to structure the ownership of the properties is important, and attorneys can help you with that as well. Property management, a lot of people will manage their own properties, and that's all good and fine. But also there are property management companies out there that specialize in it, and they do come at a cost. But what I always tell investors is that, again, is if your goal is to grow your portfolio, your time is your most valuable asset. And so utilizing your time to manage your properties means you're not using it to go find more properties. So using these professionals help you to maximize and get good at finding and investing in properties. And I think that a large piece of owning rental properties is the property management side. And for hiring a property manager, it's pretty low cost. It makes a lot of sense in my mind to do that, just simply because you're not having to deal with angry tenants, you're not having to deal with repairs, things like that. The property management does that for you. Of course, repairs and maintenance contractors, if you're gonna manage it yourself, it's important to have some repair people ready to go. So what we do is we've called around and gotten several handymen who we have ready to go when we need it. And then other providers like HVAC providers that we've built a relationship with. And so it's important to build those relationships with those providers so that you have them ready to go. Don't wait till the repair is needed to do it. Go ahead and be proactive in doing that. And the liability insurance specialist is also important. So, there is liability involved in investing in real estate. And so getting insurance in place is important, and having a good insurance specialist to help you will be beneficial to you. And the last line, I skipped this over on the top one on purpose, but IRA custodians that hold residential real estate. So we'll talk here in a little while that you can actually own real estate in your IRA. But it has to be a certain type of custodian to be able to do that. So I'll talk a little bit more about that in just a minute. Yeah, so a question was asked, any tax books on real estate that you recommend? Jennifer, there are, and you know what? I don't have them in front of me to know the names of them, but I'm happy to, I'll send them out via an email after today's presentation. But there are some great tax books that I've read that are hugely beneficial for sure. So again, protecting yourself is important when investing in real estate. And so what a lot of people will do is set up their real estate in what's called an LLC, just a limited liability company structure. And that's a way to have the property owned by a company that you own. And therefore, if the tenant or somebody that walks on your property and trips sues that house or the owner of that house, it's simply owned by a company that has no other assets other than that house. So it limits the liability. Now, keep in mind, if you get a mortgage, you're going to have a homeowner's insurance policy that typically will have liability insurance in it as well. But it's also not a bad idea to own an LLC as well and own the properties in an LLC. Same thing with a trust. The trust allows you to do the same thing. And with a trust, you typically own a interest in the property. A lot of times people will set up an LLC that will own the property, and then their trust will own the LLC interest. The whole idea here is to, again, reduce liability. So liability insurance is important. And again, if you're just going to own it outright in your name, that's where getting an umbrella liability policy in place is important. Umbrella liability is liability protection beyond your homeowner's insurance. Relatively inexpensive, but when you do it, you just need to add your rental properties onto that policy as well. And keep in mind, again, is that if you own it in your own name and you get sued, they could sue for other assets that you own. And again, that's why people will own assets outside or own real estate outside of their estate by owning it through a company or a trust. Think about liquidity. Again, we talked a little bit about this earlier. Liquidity is important. So if you're going to do a buy and hold strategy, you'll want to have funds set aside to pay the rent if need be, or I should say pay the mortgage if need be, and to pay for repairs. So very important to make sure you have a nice cash reserve set up. If you're flipping, less so, because you're getting rid of that property and that's somebody else's headache from that point forward. And remember, don't put all your eggs in one basket. So it's good to diversify. Don't buy $1 million property, maybe buy 5 $200,000 properties so that you can make sure that all of your eggs are all of your money is not in one property, but also have funds outside of your rental properties and investments as well. Invest in the stock market. It's a good place to invest, and you can pull funds from there if you need to help with your real estate as well in the future. And again, have that cash reserve set aside. Why invest now? So now is kind of a unique time frame. We are in the lowest interest rates in our history. And inflation is coming and it's here, right? So we've seen real estate inflate at 20% in the last year, actually. So real estate's been a great way to invest to beat inflation. Now, right now is kind of a tricky market because real estate has run up so much in the last year, but you're starting to see a little bit of giveaway there where I think the property values may start dropping here in the near future. And remember that rehabs are also a possibility. So, rehabs, while they've also inflated, may offer the opportunity to go in and buy at a very low cost, and then you would spend the money on the rehabbing and then sell it for market value or maybe above market value. High demand. DFW was the fastest growing metroplex from 2010 to 2019, according to census.gov. Isn't that incredible? So DFW has been growing. And for those of you that live in DFW, you've seen it for sure. So, but there are certainly other metroplexes throughout Texas right now and other states that are growing very fast as well. Low supply. So one of the things that the newspaper keeps talking about is that we are at a 40-year low. So what's driven the price demand in the last year is that there are just not enough houses out there to meet the demand. You also have a lot of people who've got some jingle in their pocket, fresh off all of the programs that the US government provided for providing funding for people. They've got some extra money that allowed them to buy some houses. A lot of those programs are waning though. And that's another reason why I think that this market will probably settle down in the next year or so. But the other thing is too, is, try to time the market is often difficult. And so, if you want to become a real estate investor, you just got to start jumping in. And if you wait for if you stop every time something happens that will slow you down, you won't be successful at it. You just got to jump in and you got to start learning, and you got to start again joining. And I didn't talk about this, but joining groups, real estate investment clubs, things like that, so you can grow your knowledge and take it slow. There's no rush, but have some goals in mind for yourself for when you want to buy properties and values, things like that. Let's talk about what type of money is used to invest in real estate. So there are two buckets of money when it comes to dollars, and this is more on the investments in the investment world. We call it non-qualified and qualified dollars. So non-qualified dollars are called after-tax dollars, meaning you've already paid income tax on those dollars. Qualified dollars are tax advantaged accounts. So things like IRAs, 401ks, you haven't paid tax on the principal. So again, here's some examples of non-qualified after-tax dollars: are cash, a taxable investment account, also proceeds from the sale of a property, or a 1031 exchange. 1031 exchange allows you to use the proceeds of a sale of a property to go buy another property. Characteristics: they are tax deductible. So something that's unique to using non-qualified dollars is that the expenses that you use to pay for that property are tax deductible. There is a capital gain tax that's due upon the sale. So when you sell that property, if the price that you paid for it is lower than the price that you received at sale, then you're going to owe tax on that gain. And that tax is based on how long you held it. And so just keep in mind that taxes would be due upon any gain that you receive. One unique characteristic of a real estate property that's purchased with after-tax dollars is called step-up and basis rules. And so step-up and basis means that at my death, if I leave my rental property to my three daughters, the value for capital gains tax actually goes up to market value. So if, let's say I bought a property for $100,000, I passed away, and I leave it to my daughter, and it's now worth $200,000 at market value. If I were to sell it while I was alive, I'd owe tax on that $100,000 gain. But if I leave it to my daughter at death, that gain is wiped away. And so she would sell it, and her basis, again, the value for tax purposes, would be $200,000. So she could sell it and not owe any tax. So that's a unique characteristic. Now, there are talks right now that may be going away with the new tax law. So keep that in mind, and you want to make sure that you keep on top of the tax law changes that are being talked about right now. However, I would tell you this, is that oftentimes, and this has already happened with this tax bill, that a lot of things that are proposed never make it. So before you get wrapped up in all the tax law changes that are being talked about 90% of them won't make it. So I always tell clients, investors, a wait and see approach is not a bad idea. I've told this story lots of times, but there was a huge tax law change back in 2017, the end of 2017. And I gave a presentation to some CPAs that I put together, spent hours on this presentation about the proposed tax law. And after I did the presentation, none of the things that I talked about actually made it. So it was a big waste of time. So point being, again, folks, is, you might wait till the tax law is passed before you see what's going to be applicable to you. And again, qualified are tax advantaged accounts. These are IRAs, workplace retirement plans, Roth IRAs. So what's unique about IRAs, and you can roll IRAs, 401ks rather, into IRAs. is that you can use them to buy real estate, but there's a limitation. You can't borrow against it. So you can't get a mortgage to buy real estate through an IRA. And therefore, there are no tax deductions too, because the money is growing tax deferred. So you pay tax on the total value when you sell the property at ordinary income tax rates. So you kind of lose some of the tax benefits of investing in real estate that we have right now when you use a qualified plan to do so. So you need to know that there are strict federal law requirements. You have to use an approved custodian if you're going to invest using your IRA. You need to be knowledgeable about required minimum distributions. You do have to take money out of your IRA each year. And so that can be a challenge if all of your money is tied up in real estate. And that's when you turn age 72, by the way. And then mistakes can be costly, including taxes and penalty. So just be aware of those rules before using your IRA. All right, folks, I'm running out of time here. And so what's the next steps? Well, take action. So I would recommend that you develop a plan of action for your first investment. So set your goals, set your timeline for when you want to accomplish that goal. I want to buy my first property by June of 2022 is a great example. Start looking for professionals that can help you. Join some organizations, read a few books, begin searching, and then once it's time, complete your purchase. All right, folks, thank you so much for your time today. I'm going to stick around for any questions that you have. And if you've enjoyed this presentation, one of the great things about UTA is they have such a phenomenal lineup of classes. I would encourage you to go to their website, that web-ded.uta.edu, and check out all the different continuing education classes they teach. It is so awesome that they have those. We also will be teaching this in 2022, several new classes. So as I mentioned, I've been teaching out there for the last decade, and we've got 4 new classes that we're bringing to the UTA that we're excited about, including several new webinars as well. So be sure and sign up for the UTA newsletter so you can keep updated on what's going to be offered. And then if you need help with investing in real estate, you're welcome to give us a call. There's my phone number, as well as my email. Simply give us a call. We'll be happy to help you however we can. Also, we will send you an email post this presentation today, where we will provide a free financial organizer. This is just a simple tool to help you to kind of get financially organized. And then we've got some great calculators on our website as well. And then again, I'll send out some good books that you can take a look at as well, if you're interested in reading some books about real estate. Other than that, thank you so much for attending today. Again, I'll stick around for the next couple minutes here and answer any questions that you have. I hope you've enjoyed it. I hope you've learned something.